We are now at the conclusion of our Chapter 10 video lecture. We're looking at how to prepare the schedule of cost of goods manufactured and sold. To complete the schedule, begin with your beginning raw material inventory. That was 0. Add the raw material that you purchased. Subtract out the ending raw material inventory, what you have remaining, to get the raw material used, 37,000. That represents your direct material cost. Add to that your direct labor, overhead assigned to get the total manufacturing cost, also known as your product cost. We'll add to that beginning work in process inventory, which would be any products that were partially completed at the beginning of the year. For us, that was 0. So total work in process is $98,300. So now we're saying, what do we have remaining in work in process at the end of the year? That amount was $3,700. Well, we subtract what's remaining from the total amount to get cost of goods manufactured. This is the amount being transferred over to your finished goods inventory account. Okay? We're going to add to that our beginning finished goods inventory. These are the completed products that were available at the beginning of the year. This shows what was manufactured during the year. So our total cost of goods for sale was $96,600. Subtract from that what we have remaining at the end of the year in the finished goods to get your cost of goods sold. So the finished goods inventory will be shown on the balance sheet as an asset. Cost of goods sold will be shown as an expense on your income statement. Okay, so let's continue with the income statement. So remember, we had sales revenue of $153,000. Subtract from that the cost of goods sold that we just saw on our cost of goods sold and manufacturing schedule to get a gross margin of $59,600. Okay? Next, we talk about what's known as a just-in-time inventory. Just-in-time inventory. So with a just-in-time inventory, is when a company will order product that's needed in order to meet the demands of their consumers. So many inventory holding costs are obvious. So we're talking about financing to purchase inventory, warehouse space, supervision, theft, damage, obsolete. Other costs hidden are diminished motivation, sloppy work, inattentive attitudes, and increased production time. So we're saying, how can we eliminate a lot of these holding costs? That can be done by implementing what's known as a just-in-time inventory system, also known as JIT. With this type of inventory system, businesses have reduced their inventory holding costs and increased customer satisfaction by making products available just in time for customer consumption. So now we're saying we're going to pretty much order products to make inventory based upon the demands coming from our customers. The benefit is that we're going to use Paula as an example. So Paula Elliott supports herself by selling flowers. She re-engineered her distribution system by purchasing her flowers from florists within walking distance of her sales location. By doing this, there's elimination of non-value add activity of driving to the former florist. So now, as there are orders coming in from her customers, she's going to go to a local florist within walking distance of her sales location to sell these items to her different customers. It also avoids what we call loss of opportunities by not turning away prospective customers. So pretty much what Paula would have will be a catalog showing the different flowers sold. And as a client orders these products, probably online, if you will, then she's going to now make the purchase from the local florist. Let's take a look at the income statement for the months of May and for the month of June. Here we have an income statement for May that shows sales revenue, cost of goods sold, gross margin. Again, this is the income statement for Paula. This was her driving expense, $45. Excess inventory waste, because with flowers, flowers can wither and they can't be sold. So her net income was $195 for the month of May. But once she implemented the just-in-time inventory system, sales revenue was $930, cost of goods sold was $620. Notice that the product cost is $2 per unit. She sold more units in June. Gross margin was $310, but notice this. Now there's no driving expense nor any excess inventory waste. So net income increased to $310 in June compared to $195 in the month of May. Okay? So we see that May sales suffered from the lost opportunity to earn a gross margin of $1 per flower on 30 roses. An opportunity cost of $30. Okay? So opportunity cost is missing because we do not record opportunity costs on the actual income statement. We only show the actual cost. Okay? So that will conclude our chapter 10 video lecture. I hope you've enjoyed our first chapter covering managerial accounting. See you later.